Hello and welcome to Portfolio Matters Weekly Markets Checklist, week 104, and it's been a very eventful week. But before we get into it, Richard will read the disclaimer.
Thank you, Keith. Everything discussed during the Portfolio Matters podcast is for informational purposes only and should not be considered as investment advice. Listeners should be aware that we will be discussing securities that we own or have a financial interest in. Please do your own research or consult a professional investment advisor before making any decisions regarding topics mentioned on the show. A full disclaimer can be found at the end. Keith, what do we have this week?
Thank you, Richard. Well, it's been a very eventful week dominated by the various central banks. So the Fed raised rates by 25 basis points this week, but reiterated that it did not feel the battle against inflation had been fully won and that further rises would be necessary. Now, last week, Richard and I forecast what the Fed was going to do, and I thought they were going to raise by 50 basis points. They didn't. They only raised by 25 basis points, and the markets were off to the races. The Nasdaq was up over 3% yesterday as markets looked through to the end of the current rate cycle. In Europe and the UK, both the Bank of England and the ECB raised by 50 basis points. And everywhere, interest rates are still rising and are at their highest levels for many years. In the US, we had job openings for December. We'll show you the data later, but that was surprisingly strong. And Jerome Powell would have been aware of the tight labor market when he decided to only raise by 25 basis points. Elsewhere, the IMF forecast that the UK will be the only major economy to contract this year. And European gas prices are now lower than they were a year ago, and the European economy has survived the winter energy crisis remarkably well. Some charts relating to the news. So after the FOMC meeting, the markets have revised downwards their expectations for the Fed policy rate. Now, I'm going to read this as a quote from Jerome Powell's speech afterwards. It would be premature. It would be very premature to declare victory or to think we've really got this, Powell said. We see ourselves as having a lot of work left to do. He's talking about the fight against inflation. So the markets have taken the cut in the pace at which the Fed is raising rates very well. But rates are still rising, and Jerome Powell is expecting rates to peak at over 5%. The Nasdaq rose by 3.25% yesterday. So the markets, all markets, seem to have taken the slower pace of rate rises very well. And in Europe, Christine Lagarde raised rates by 50 basis points, 2.5%. And said that she intends to, but has not committed to, raising them further, which is significantly softer language than she used last meeting. These are EU gas prices, and after that extraordinary spike, they have really fallen back, and they're now lower than they were prior to the Ukraine invasion. Amazing. So on to this week's economic data, and I'm afraid there's a lot of it. So starting in the UK, we had mortgage approvals for December, and they were down by a lot. We had about a 25% drop in both mortgage approvals and mortgage lending in December. The UK housing market is slowing rapidly. In the EU, we had various sentiment surveys. So the headline sentiment index rose in January from December to 99.9, and that beat expectations. Industrial sentiment also rose and massively beat expectations, coming in at 1.3 against expectations of minus 1.2. Services sentiment also rose very strongly to 10.7, up from December and beating expectations by a margin. Selling price expectations declined more than expected. So the Eurozone economy seems to be doing better than in December, and inflationary forces are declining. That is all good news. And if we look at the European inflation numbers for January, they came in, the headline CPI came in at 8.5% against expectations of 8.9%. So better than expected and a big miss. That was well down on December's figure of 9.2. Core CPI inflation came in at 5.2%, unchanged for December, but again, lower than expectations. Moving on to China, we had the NBS PMIs, and they all showed a big bounce from December to January. And the Chinese economy seems to be expanding again after lockdowns. Now, we also had a lot of US data. So pending home sales in January showed a surprising bounce. They actually rose 2.5% month on month against expectations of a decline. Year on year, though, they're down 34%. So the US housing market is not doing well despite the little January bounce. We had PCE inflation. Remember, personal consumption expenditure inflation is the Fed's preferred measure of inflation. And those numbers were reassuring for December. Inflation came in at 5%, lower than November and beating expectations. Core PCE inflation came in at 4.4%, again, down on November and beating expectations. We also had the ISM manufacturing PMIs. Well, they weren't great. So the headline number came in 47.4, down on December and below expectations. Employment continues to hold up, though. It came in at 50.6, below expectations, but still above 50. New orders fell further to 42.5, so manufacturing activity is likely to contract further in the coming months. But the bad news was that prices paid bounced hard to 44.5. So the disinflationary price pressures in the manufacturing sector were reduced last month. Now, we also had job openings for December, and they were strong. So against expectations of a fall, they actually rose. So once again, it seems that the US jobs market is tight, though we have had some numbers for January, and they point to a weakening jobs market in January. So the ADP, which uses actual private sector payroll data, they're saying that in January, the US economy only created 106,000 new jobs compared to 253,000 in December. And the Challenger job cuts, which document intended job cuts by private sector firms, rose from December into January. So the January employment picture is looking worse than December. So the jobs market in the US may be weakening. Now, next week, we get non-farm payrolls for January. Let's see. We also had some quarterly data. So European GDP growth quarter on quarter in Q4 was 0.1%, and year on year was 1.9%, both better than expectations, but still down from Q3. And the US employment cost index quarter on quarter came in at 1% in Q4, which was better than expected. So wage inflation is weakening. Richard, some charts.
Thanks, Keith. So your UK mortgage approvals. It's interesting, isn't it? The UK house prices haven't really started to fall yet, but I suspect that they will do in due course with this mortgage approval and actual mortgage loans taken out data. Now we have mortgage lending, which is on a par with what it has been probably, between 2015 and 2020. So
yeah,
but it is heading down quite quickly.
I think there is a big gap between this chart and the last one. I think the reason is that mortgage approvals lead mortgage lending. So the mortgage lending is from mortgages were approved like last month or a couple of months ago.
Yeah, that's a good point, Keith. And UK net lending to individuals is showing signs of falling quite sharply, which would predicate a slowdown in retail sales, particularly. UK nationwide house price index just tipping back down gently, but potentially has a long way to drop back down to even regain that trend line of the pre-COVID trend line.
Yeah.
EU CPI year on year, it's looking a little bit like the US chart, but with a delay of a couple of months. The EU economic sentiment index, which is looking quite healthy at the moment.
Yeah, well, it's back to neutral.
Yeah. EU industrial sentiment, it's okay.
Yeah.
EU services sentiment is looking quite good, actually.
It is, yeah. That is well above the neutral line.
Yeah, it never hit neutral. EU selling price expectations dropping quite fast. I guess the decline in energy costs has a significant impact on those expectations.
Yeah, the massive fall in natural gas prices will seriously reduce energy bills.
Yeah. And EU consumer confidence is moving up quite sharply, having really plumbed the depths a couple of months ago. The EU GDP growth is effectively a zero quarter on quarter. So
yeah,
we shall have to see where that goes. Year-on-year growth looking a bit more healthy, but the concern, I guess, is the quarter-on-quarter growth recently has been very low. US pending home sales is month-on-month is actually increased.
Yeah, very puzzling.
Yeah,
must be seasonal.
And US inflation PCE inflation continuing to fall back year-on-year. Likewise, with core PCE. I think there's a continuing debate as to whether, everybody says these things are going to drop back to 2%. I think there's a debate as to where they will drop back to. Indeed, will they drop back below 2% if there is a big economic slowdown?
Well, we've got the Bank of England inflation forecast coming up, and they're actually forecasting that inflation not just goes back to 2%, but goes below it from 24 onwards. But, one thing we do know is they always get their inflation forecast wrong. So that's the one thing that's not going to happen.
And it's part of their propaganda that, they talk things in the direction they wish them to go. Clearly, because it would be bonkers to talk them in the opposite direction. US ISM manufacturing PMI, it's still falling pretty consistently. It has been for the last 6 months. But employment is not reflecting that in the same way.
Yeah. So this is one of the reasons I think profit margins must contract in the US. You've got falling activity, but you're maintaining employment.
Yeah.
Your profit margins get squeezed.
That's a good point, Keith. Yeah. And new orders is also falling fast and consistently. So there's a lot of we discussed this last week. There's a lot of contradiction in the data.
Yeah.
US manufacturing prices paid has just ticked up a little bit, but it has fallen a long way from its highs in the middle of last year. And the jobs openings is looking very buoyant. We did talk about the other week the fact that there's a lot of uncompleted property, residential property, that constructors are rushing to complete so they can actually get it onto the market. And that is sustaining employment within the residential housing sector. Yeah.
And I think what is really different in this particular construction cycle is that there are a record number of multi-family apartments being built as opposed to single family. And the multifamily, obviously, are much bigger projects, which will take longer to complete. And therefore, construction sector employment is probably likely to hold up better than in previous cycles. But at the same time, single family construction remains the vast majority of the home construction market, and you would expect that activity there to slow as home sales fall.
Yeah, and the quits rate is pretty high. I mean, it's basically come back down to that trend line since 2009.
Yeah, the US jobs market as of December still seems pretty hot, frankly.
It does, doesn't it? Yeah. And the Challenger job cuts announcements which we first introduced probably 4 weeks or so ago, Keith, which is much more of a real-time estimate of what's going on in the jobs market, is rising. It's not huge, but it is definitely on an uptrend.
Yeah.
And the ADP employment change January, very low, the lowest it's been for the duration of this chart.
Yeah. So let's see what non-farm payrolls do next week.
Pending home sales year on year, it has fallen substantially, and it is yet we have to see whether it's reached the bottom or whether it's going to go further down. The US Fed manufacturing index well below zero. So US Red Book retail sales, this is a fairly short-term chart, but it shows there has been a significant decline since the middle of last year.
Yeah.
So, retail sales activity.
Yeah. So this is real retail sales taken from till data, and it's the year-on-year number, but it's updated every week.
And the Case-Shiller house price index month on month is showing consistent declines now since the middle of last year. And the same thing with the year-on-year chart. Although it's still positive on year.
Yeah. I should also say that data is for November, so there's a bit of a lag.
Yeah. And the MBA, the 30-year mortgage rate in the US is just falling back a little bit to just above 6% now.
Yeah, but still double where it was last year.
And the US mortgage market index is at a low for this chart, and not really showing signs of improving yet. China manufacturing PMIs, I mean, you would expect this to soar actually as China reopens.
Yeah.
It's had months and months, years, and in fact, very poor figures. You'd expect some really fast catch-ups. I would expect to see that line going well above 50 over the course of the next few months.
Yeah.
And non-manufacturing PMI, same thing, same comment. And general PMI, obviously, same comment. So we can see the effect of rising interest rates on the UK housing market. And the housing market tends to lead the economy. In the EU, there was a big rise in economic sentiment, and services doing particularly well. They've got through possibly what is the worst of the winter period without the dire predictions of energy shortage, energy crisis coming to pass. So fingers crossed that's now in the rearview mirror. And the US ISM manufacturing survey is showing continuing decline, but the US jobs market is showing continuing strength. So you have this contradiction here. We've got the Fed continuing to increase interest rates. They must actually be wondering what's going on. Whilst the US jobs market is remaining tight retrospectively, the January figures are suggesting, the challenge figures are suggesting there may be a bit of a slowdown in the jobs market coming. And we get the non-farm payrolls for January next week, which may shed a bit of light on it. And Chinese economy is opening up fast, I think.
Okay, thank you, Richard. On to one chart. And this chart shows in the blue the percentage of workers that various tech companies are laying off. And in the orange, the share price change after the layoff announcement. And we talk about how the traditional mechanism by which an economy goes into recession is that higher interest rates discourage capital investment, And the first sectors to go into recession are the housing market and the manufacturing sector. But what this chart shows is that there's now a third mechanism because of the very high financialization of the economy. The moment that the share price starts to fall, CEOs are incentivized via stock options to try and keep the share price up. So when the share price starts to fall, they start laying people off. And there is a fallacy of composition here. If they all start laying people off, then there's a lot of more unemployment, people spend less, there's a fallacy of composition, and their sales will fall. But what the orange bars show is the market doesn't care. It's incentivizing CEOs to cut staff. And on to Inflation Watch, Richard.
Thanks, Keith. So EU data for January, the CPI was 8.9%, which was a reduction, and core CPI was 5.2%. But the EU has raised interest rates to 2.5%, still very far short of the US and UK rates, which have both raised interest rates, US 4.5 to 4.75. They have a range, and the UK to 4%. Bearing in mind that the UK base rate, was it 0.5% a year or so ago?
I think it was actually lower than that, wasn't it? 0.25%.
So this is enormous. If you're mortgaged or indebted up to the hilt and you're not fixed, this is an enormous relative increase in your interest rate burden. And I sort of rather suspect that the consequences of these have yet to come through into the economy.
No, I completely agree, Richard, because in the case of the UK, we know that actually most mortgages are either 2-year or 5-year fixed. And so a lot of homeowners won't feel the effects of higher rates until their mortgage needs to be refinanced. We know that 4 million households will refinance in the next year.
Which is going to be very unpleasant for them.
Yeah.
So UK pay growth is remaining very high. I mean, 10% PAYE measure, which is obviously done off tax returns from companies for their monthly payrolls, is at nearly 12%. And the average weekly wages at 8%. And this does lend itself to a wage price spiral.
Yeah, well, we will have to see how the latest round of public sector strikes gets settled.
Yeah, indeed, with difficulty.
Yeah, but undoubtedly with some decent pay rises, I would have thought.
Yeah, which of course increases the burden on the exchequer. So, I mean, the danger is that we move into stagflation. And I do think there's a significant danger that we move into a recession with still significant inflation.
Yeah, I agree.
So 3 months change in US core PCE inflation is falling fast. At 2.9%, yes, it is above the Fed's 2% target, but I would suggest not that much above it for the Fed to be worrying personally, especially given they may be under some political pressure from the Biden administration and the presidential elections in, what is it, just under 2 years' time now?
Yeah. So
if we exclude rents, the 3 months change in core PCE inflation actually fell to 1.75% in December from its peak of 7.4% in June 2021. So what we say there is that excluding rents, we're below the 2% target.
Yeah, absolutely. So inflationary pressures are actually fading quite quickly.
Yeah. Shipping costs. We've been watching this graph and they have completely plummeted. They're back down to sort of the lowest general position they were pre-COVID. So the all of those new ships that are being built in 2022 they're going to struggle to pay their way.
Absolutely.
Don't invest in shipping, maybe. And Trueflation is drifting slowly lower. So this is from the Trueflation website, and however they measure it, it's fallen from 12% to 6%.
Yeah, although the rate of change seems to be plateauing, frankly.
It does, doesn't it? Yeah. And UK trueflation, has it started to decline? Well, it stopped rising at 20%.
Yeah, I know. Still very, very high.
Exactly. So we think inflation has probably peaked. The question, of course, is how quickly will it decline? And then also the question is there that our economies entering into a wage price spiral, and what effect would that have on inflation?
Well, my own view is I don't think we are. I think workers are trying to compensate themselves for inflation that has already happened. You get a wage price spiral if they anticipate higher inflation in the future and demand higher wages to compensate for that. And I don't think we're seeing that.
Yeah.
Okay, thank you, Richard. On to recession watch. So this is German industrial production in energy intensive sectors. And you'll see the expectations have bounced right back. So as energy prices are falling, then that will provide a decent boost for German industry. But reminder, the Eurozone is raising interest rates for the first time in a long time. And as a result, credit growth is collapsing. And house prices in the Eurozone have been extraordinarily high, and with rising mortgage rates, they become unaffordable. So you're seeing mortgages collapse. And reminder, the traditional mechanism by which economy goes into recession is the housing market weakens. And you're seeing that here. So we showed this chart last year, and it's an absolutely extraordinary chart. So this is an index of house prices and rents in Amsterdam going back to 1620. And you'll see for the vast majority of the time, there's a very tight relationship between rents and house prices. But then in the last few years, as the ECB has essentially cut rates to zero, house prices have gone absolutely ballistic and become totally unanchored from rents. Well, you would expect the two to come back into some sort of alignment, which would mean a big fall in house prices. So this is Germany, and there has been a big fall in new orders, which is the white line. But you'll see that industrial production over the last 2 years was stable and did not meet new orders. So there appears to be a backlog of new orders, which will keep German industry going for a while.
I'm gonna put a potential alternative interpretation on that chart, Keith, which is the data's wrong, because if you're running a manufacturing industry, you place a new order in where that peak is just above 120. You can't wait a year and a half for it to come.
Yes,
because
that's a good point.
Won't function. I mean, you maybe if you've ordered some piece of high-tech equipment that takes 2 years to manufacture, but so my suspicion is that there is some other factor at work here as well.
Yeah, but also it's an index, Richard, so you could well be right. Now, in the US, temporary workers are a leading indicator. So the first people you fire are temporary workers, and you see the number of temporary workers is starting to decline. The decline's not big yet, but you'll see prior to every recession, you get a decline in temporary workers, and that's happening now.
The other thing interesting about that chart, Keith, is that even the decline that we see now is large relative to non-recessionary declines.
Yeah. And the black line here is housing inventory as a function of home sales. And you see that it has risen very sharply as we know a lot of new housing is coming onto the market and sales are collapsing. Now, historically, there's been a very good correlation between housing inventory and the unemployment rate. And so we'd expect the unemployment rate to start rising soon in the US. UBS have a model for the JOLTS job openings number, and they're forecasting that it will start falling now. In fact, they've been forecasting it'll be falling for a bit. And signs of increased financial stress for US consumers. This is auto loan delinquencies, and generally people will do their utmost to retain their car. So it's one of the last things they default on. Goldman Sachs seems to believe that the worst is over for US housing and house prices will start rising from here. Now, I just don't understand how they can think that, given that the hypothetical monthly payment on the median US house has risen by 80% since its lows in the pandemic. So US housing is just unaffordable at these levels for the vast majority of people. So I just don't see how house prices can start recovering, particularly as interest rates are still rising.
Presumably, their chart comes. They sell house price futures, and people buying the futures are betting that the house prices are going to go up from here. But just because people are betting it doesn't mean to say that they're right. People were betting that interest rates are going to stay low forever, and they didn't. So I think one needs to take that type of data with a very large pinch of salt.
That's a very good point, Richard. Of course, during the financial crisis, Goldman was saying one thing and doing another, as though they try to offload their mortgage book onto their clients.
Surely not, Keith.
No. Now, the Economic Surprise Index in the US is rolling over again. So we have had this period for the last quarter where the economic data was getting better. Well, that's no longer the case. And US consumer demand is now falling, driven mainly by durable goods demand. And so that new orders number we showed earlier can be explained by higher interest rates putting off consumers from buying large items. Service consumption is still growing, but the rate at which it's growing is declining. And the Conference Board leading economic indicator has got a very good track record of forecasting recessions. And you'll see here that it's forecast correctly every recession. It's forecasting a recession now. The problem is that it forecasts them with a variable lead time. So the lead time has been between 3 and 15 months. So the Conference Board are forecasting recession. We're just waiting for it. And we don't know when it will arrive, but we're pretty certain it will arrive. And US retail spending, actually real spending, is on trend. So US consumers have managed to maintain their spending so far, but we know they're running down the savings they accrued during the pandemic. And further evidence of declining economic activity in the US is cardboard boxes. So the number of cardboard boxes being used is in decline. And I think that's a great piece of real-world data and reminder that the bond market continues to forecast a recession very firmly. This is the current forecast for US GDP from the market. So the market is expecting GDP growth in Q1 of 0.23% and then 2 quarters of negative GDP growth in Q2 and Q3. That is a technical recession, but the market is currently forecasting a very shallow recession. We think it's going to be worse than that. So in summary, interest rates still rising. Economic activity in the US is still slowing, but in Europe, it seems to be stabilizing. A recession is coming in H2 in the US, but the market expects this to be short and shallow and appears to be betting quite a lot on that being the case. We think it will be worse than that. And therefore, equities are likely to do poorly in the second half of this year. Actually, in my own opinion, starting from now, pretty much.
Yeah, I would agree with that.
And onto the US presidential cycle, as Richard was talking about earlier. So this is really interesting. So during the 7 months of the presidential cycle, from the 1st of October in the second year, which this cycle is 2022, to the 30th of April in the third year, which in this cycle is 2023, so i.e. the 7-month period starting last October, ending 30th of April this year, the returns of the S&P 500 equal the returns in the rest of the presidential cycle. And that is using data for all the presidential cycles since the 1930s to now. So why? Well, politicians need to be re-elected, and voters tend to be influenced by the state of the economy in the 6 months prior to the start of electioneering. And that means politicians will attempt to stimulate the economy 12 to 18 months prior to the, sorry, that should be 18 to 12 months prior to the election.
That suggests, Keith, that people lock in their voting intention, and then it doesn't get changed from that point forward by what's going on in the economy.
It does, doesn't it? And maybe they just get bombarded by far too much information in the final 12 months.
Yeah.
And the stock market tends to respond very strongly to this stimulus. Now, I should also say that this is Jeremy Grantham of GMO's explanation for why that is the case. But it is puzzling that politicians should wish to stimulate the economy so far ahead of the next presidential cycle. As Richard points out, that means that they have actually decent memories, and also they're not influenced by current economic conditions. So then the question comes, will it work in 2023? Because that essentially is forecasting that the best period of the stock market will be between last October and this April. And we know actually that equity markets have had an extraordinary run over that period. But the Biden administration does not appear to be attempting to stimulate the economy. We have had an uptick in economic forecasts from previous pessimism, but the US economy is slowing, the housing market's doing badly, and the Fed has continued to raise rates strongly since October. And we also know that the US government has hit the debt ceiling a couple of weeks ago and is now running down the TGA account. Now, we did a piece a while ago on how spending the TGA pumps money back into the economy and is generally good for the S&P 500. And that effect is likely to last for the next few months at least. So it's certainly true that since October, the market's been doing very well. I'm not sure I believe the explanation from Jeremy Grantham, but the effect seems to be there, and it seems to be quite strong. If anyone has a better explanation for what's going on, please get in touch. And onto the UK economy, Richard.
Thanks, Keith. The Bank of England is predicting the inflation will fall to its 2% target next year. I've seen this chart somewhere before.
It's like every time inflation sparks since 1612, I think.
It's the Bank of England 90-degree chart.
Yeah.
Or 110-degree chart.
But I mean, the extent to which they think inflation is going to fall, I think is extraordinary. So they're saying by 2026, we're back to 1% inflation.
Do you remember that bit of research we looked at that was done by, I can't remember the firm, and basically it said in inflationary episodes, this is what tends to happen. And it takes years if you have a sharp inflationary episode like the one we've had. Historically, it's taken years for inflation to actually fall. Yes. And this every time is different, potentially, but this certainly doesn't reflect that point of view, that actually it's going to take 6 or 8 years for inflation to revert back to low levels.
Yeah, and I'd also say, Richard, that I don't think the market believes this, because we know that very long dated gilts are currently yielding about 3.5%. And if you expect inflation to go down to 1%, you're talking about 2.5% real yield.
Yeah,
No.
doesn't look realistic, does it? So they're expecting a shallow recession, but output will not return to pre-COVID peak until 2026, which is pretty dreadful. I hope there is a shallow recession. I do think, these central banks pronouncements, clearly they're taught their own book, don't they? They want inflation to fall and they don't want a recession.
Yeah.
And do the opposite.
But I would say on their side that a lot of the reason that the UK was going to go into a hard recession was because of very high energy prices, and that has faded a lot. And that's a big stimulus to the economy. And now that households need to spend less on their energy bills, they can spend it elsewhere.
It's very true, Keith. But the Bank of England thinks that the UK economy can't grow more than 0.8% per annum without generating inflation, which suggests that they think that we simply cannot increase productivity.
Well, we have a very poor history of productivity growth. We'll show you a chart in a second.
I don't understand this case at all. I know this is a huge topic, I'm sure, but you look at the increase in productivity that IT has given businesses, it's massive.
Well, the thing is, Richard, when we talk about IT, how much of it is actually measurable in the GDP figures? Let's talk about information finding. Now, you and I used to, if we wanted to find something, we had to either go down to the library, buy the Encyclopedia Britannica, etc., or now we can just look it up in Wikipedia instantly, which is fantastic.
Yes.
But how much has that affected GDP? Actually, previously would have had to buy the Encyclopedia Britannica. Now it's free. You could say GDP's actually declined.
Yeah, I mean, quite right, Keith. And that, of course, then comes to the point of, well, GDP is the major input, one of the most important inputs into calculation of productivity. Are we measuring GDP correctly? Now, I don't know the answer to that question. I don't even know particularly how we measure it. How the Office of National Statistics measure it now, but it just doesn't feel right. So this is what's happened to UK productivity since the Great Financial Crisis, and it has shifted off its long-term trend to a much lower trajectory.
Now, I've got a couple of points on this. For me, is that I seriously wonder how much of the pre-GFC activity in the UK was illusory. So we were creating lots of financial wealth that then turned out to be just not there. And the UK economy was, gambling essentially on financial services. And we've since, dialed that back, restraining the banks and not allowing them to do all this gambling.
Yeah.
And the other thing I'd say is that we have, for the last 30 years, really benefited from the North Sea. And as North Sea production falls, so the UK's productivity will also decline. So there are a couple of headwinds there.
I think those are very good points, Keith. Particularly, the coincidence of the GFC with the change in the slope is remarkable, isn't it?
Yeah.
And UK investment has not recovered from Brexit, and it's really looking rather sick, isn't it? And we do need UK investment to be above the 100 line and heading upwards in order that we maintain pace with our competitors, particularly in high-tech businesses, which we claim we want to major in as part of our economy, although government policy seems to actually suggest that they want the opposite to happen. They say they want it to happen, but they're not doing the right things to make it happen.
Yeah, well, this is quite a depressing chart, frankly.
Yeah. And the IMF is forecasting that the UK will be the only major economy that has a recession in 2023.
Well, I think they're wrong. I think a lot of them are going to have recession this year, frankly. but, keep us company.
So a lot of issues really to fight. Brexit, the pandemic, high energy prices all damage economic prospects of the UK. And so we have a very low growth forecast, lower than the rest of the G7 in 2023 and beyond. And higher energy prices now fading. So the disruptive effects of the pandemic will also fade with time. But of course, currently, we have got a very high level of business bankruptcies. And the same must be true all over countries that lock down, I would imagine. And of course, we do need to get our investment back up to pre-pandemic levels and on an upward trend. And we need government policy to ensure that happens.
Okay, thank you, Richard. Okay, on to US labor force participation. Now, reminder, since the pandemic, the participation rate for over 55s has had this step down and it's not recovering. So the US has lost, what's that? Over 1 million people over the age of 55 from the labor force. And there was a paper out this week that suggests that that effect can be explained entirely by the rise in house prices. So reminder that the Fed and all the other central banks around the world cut interest rates to close to zero. Did QE, pump the economy full of cash, and house prices everywhere shot through the roof. In the US, they were up over 20%. And, so this is the case Schiller, US house prices were not up 20%, they were up 40%, sorry. And all that meant that people with homes had enough money to retire. Now, I accept that narrative, but we have previously talked about long COVID. And this is from the Brookings Institute. And they're saying that between 1.8 million and 4.1 million workers have fallen out of the labor force because of long COVID. Now, the US labor force is currently 159 million. So that's between 2.6 and 1.1%. So the explanation could equally be long COVID. But if we believe the paper and it's all due to higher house prices, well, that's actually better news, because it means that as house prices fall, and they're going to have to because interest rates have shot up, then some of these workers could come back into the labor force, and that would reduce wage inflation. And on to US GDP numbers, Richard.
The US GDP growth has been surprisingly strong. So this is showing change in real private inventories, the red bars, and the GDP growth in the thick blue line. And you can see the GDP growth, how post-COVID is continuing on the pre-COVID trend. In fact, the post-GFC trend. This is a chart that shows the different contributions of various elements of the economy to the percentage change in real GDP. So residential investment has made a big negative contribution to real GDP of late. And we can see that equipment and software is actually still above neutral, but is declining towards neutral, and non-residential structures is below neutral. So the dotted line is change in private inventories. So basically, you're sort of adding all of this lot up and trying to see what's having the biggest effect on the current GDP levels, and what's having currently the biggest effect on current GDP levels is residential investment. And we would expect residential investment to continue to fall for reasons that we've discussed in the foregoing, which suggests that GDP is going to continue to fall. But there are some other investment categories, such as intellectual property products, which are on a powerful uptrend, really, and have been since 1947. Equipment and structures not really falling, as we saw sort of in the previous graph. This makes it clearer. So there's a couple of items that are particularly contributory to the fall in GDP.
Yeah, you see in most recessions, equipment investment starts to fall, and are expected to do so now that interest rates are rising and the cost of capital investment generally is rising.
So the fall in investment has been offset by the build in inventories, which we've been discussing over the last few weeks. And at some point, this build in inventories will stop because obviously the property sector is going to have to slow down if it can't clear its inventories. At that point, we should see the property sector start moving, reducing employment, reducing activity, and contributing to a decline in GDP. And inventories rose by 130 billion in Q4. And obviously, we had a lot of inventory declines during COVID. By this measure, difficult to say whether there's anything significant going on there at the moment. And a rise in inventories suggests that businesses will cease or reduce the rate of ordering in the future. So they don't want their inventories to get too large, tie up too much working capital. Bullwhip effect, this is basically saying that a small change in customer demand can ripple through the economy and have magnifying effects as each sector in the sort of path back to the basics, the supplier of the basic materials going into what the customer buys, feels a very significant change in each sector. It just magnifies the effect slightly. It's the butterfly in a forest, isn't it?
Well, it's actually, Richard, it's not really, because here, butterfly and forest, you're talking about random effects. Here, you're talking about quite predictable effects.
That's true. Yeah, very true. But it does show that the economy is decidedly non-linear.
Yeah, that's true.
So this relatively strong GDP data we're getting out of the US is it's also contradicting the sales data, which suggests the economy is much weaker. So there's a lot of moving parts in this discussion.
Well, it suggests, Richard, that final sales data is weaker than the GDP numbers. So that is consistent with a build-up in inventory, which can't carry on forever.
That's very true, Keith. Yeah. So a healthy annualized GDP growth, nearly 3% in Q4 for the US, but nearly 1.5%, or half of it, was due to a build in inventories. So we're suggesting that retailers are overstocked. The cutback in new orders will magnify its way up the supply chain or down the supply chain, whichever direction it goes in, lead to a significant slowing in manufacturing activity, which will be reflected in future GDP figures. And ISM manufacturing, as we saw earlier, is in significant decline.
Yeah, that's new orders. Okay, thank you, Richard. On to food prices. And Kantar this week reported that UK grocery price inflation rose further in the 4 weeks to 22nd of January and now hit 16.7% year on year. And that's a rise of 2.3% from December. UK households face an extra £788 on their annual grocery bills as a result. Now, what's going on? Because we have previously talked about declining food prices. So actually, before I get into that, according to the ONS, around 15% of the UK population are worried about running out of food, and about 5% of the population actually did run out of the food in the last 2 weeks, a report they did. Those numbers from the Office of National Statistics. But we know that fertilizer prices have collapsed as natural gas prices have fallen, and that food prices should follow fertilizer prices down. And we previously reported these numbers from the UN Food and Agricultural Organization showing that food prices have peaked. So how come UK food inflation is still rising? Now, we haven't been through the agricultural commodity prices in a while, and I thought this was an opportunity to do so. So this is canola, which, reminder, is rapeseed oil, and you see it's well down from its peaks, but seems to have stabilized. Coffee, again, well down from its peaks, bouncing back a bit. Corn has actually risen over the last 6 months. Milk, never really had a spike. Down. Oats completely unwound the extraordinary spikes of the last year and is back down to its pre-invasion levels. Palm oil, the same. Rice, actually, rice has been climbing on the back of China reopening, apparently. Soybeans, now soybeans are actually in an extended bull market, and they are down from their peak, but the price is recovering again. Sugar, actually, that's a bit, again, a decent climb over the last couple of years. Wheat, all the extraordinary spike caused by the invasion of Ukraine has unwound. So, in general, I think you can say that agricultural commodity prices have fallen a long way since their peaks following the Russian invasion of Ukraine, although the falls seem to have stopped and a lot of them are rising again. But that all makes the recent rise in UK grocery prices rather surprising. And I put it down to lags in food manufacturing and supply chain. And in due course, you would expect lower agricultural commodity prices to feed through to lower UK food prices. And onto other charts, Richard.
Thank you, Keith. So this is a heat map of global business activities measured by the composite PMIs for major economies. So if it's the more red it is, the more contractionary the economy is. And it just shows, the trend from February 2022, where only Japan was in contraction, up until January 2023, where 5 of these 7 countries were in contraction, and the other 2 were Eurozone and Japan were only just expansionary. So it shows a declining trend of economic activity as by this measure.
But also, there has been an increase in economic activity from December into January, but it's quite weak. And the market has had a huge bounce on the back of that. So to me, it seems that they're getting a bit carried away.
Yeah, it's also been quite partial, I think, hasn't it? Well, the UK actually is fairly rubbish. Apart from the UK, it has been a bounce. Yes. Oh dear. And the US has had the strongest recovery since the pandemic. So the blue line at the top is the US, the red line at the bottom is Spain. And you can see that the differential is pretty big, actually.
It is, yeah.
And the US government expenditure percentage of GDP has been on a relentless upward climb since 1926. And is now, if you ignore the COVID numbers, it's about 40%, 45% of GDP. And at some point, this becomes unsustainable.
Yeah, no, it's approaching European levels.
Private debt in Canada is higher than Japan at the height of the asset bubble. I mean, the Canadian property market is ripe for something unpleasant to happen, I think.
Yeah.
And we have seen this sort of data presented in different ways before, but these housing markets, Canada, Sweden, Australia, very exposed to rising interest rates. I think New Zealand is as well, but New Zealand isn't actually on this chart. But some countries are very, very vulnerable to rising interest rates with their housing market. Housing market is the economy, so
yeah,
it's not good.
Just to explain this chart, on the x-axis, it's the share of new mortgage issuance that is variable rate, and the y-axis is household debt, a percentage of disposable income. So the further you move top right, the more exposed you are to changes in base rates.
And GMO's 7-year asset return forecast remains negative for US equities. I'll put a caveat in there, which is unless the Fed starts to do QE again once the US economy goes into recession.
Yeah, but this is also the average over the next 7 years, Richard. I mean, I think as the US economy goes into recession over the next 2 quarters, then you'd expect, US equities have a bit of a bad time, and hopefully to fall to a bottom at which they represent decent value and you then have, good returns.
Yeah, that's true.
Okay, on to good news. And this is an Indian rhino. And last year, the Indians decided to actually take poaching of the rhinos seriously, and they put in extra measures, including people just to look after rhinos 24 hours a day. As a result, no rhinos were poached in the Indian state of Assam last year. And it has a rhino population of actually almost 2,900, which is quite impressive, I thought.
They are incredible creatures. If you ever see one in a zoo, I mean, I'm sure they look nicer in the wild. I haven't seen one in the wild, but they are fantastic creatures.
Yeah, they look prehistoric. Anyway, some good news out there. Equity markets, Richard.
Thank you, Keith. So I think, generally speaking, we had a pretty good week in the equity markets, apart from the Hang Seng, which clearly didn't have a good week. NASDAQ up 6%. Cassie Wood, ARK, will be rubbing her hands with glee. The S&P 500 up 3%. FTSE, even the FTSE up 1%. And stocks Europe up 0.7%. Then we have Bitcoin, had a decent week, 1.8%. The pound fell 1.5% against the US dollar. The euro actually rose against the US dollar. And the dollar index is unchanged for the week. And the VIX is down. VIX basically is the inverse of the S&P 500, give or take.
Yeah, well, I actually opened a spread bet earlier in the week on a very small amount, just to see if this works.
Yeah.
So as VIX went below 20, I shorted the S&P 500, which promptly rallied by 3%. So there you go. The VIX is now saying it's even more of a sell, and it's a trivial amount, and I'm keeping it on.
You're keeping it on. So I took mine off a couple of weeks ago, as I think I said, and I'm wondering if at some point I should put it back on exactly the same as you, Keith, a tiny amount, just as a bit of fun. But I'm starting to lose my faith in it.
Really? No.
We'll see. So we have the Hang Seng, which has been on a nice little run up since November.
Yeah, 20%. Absolutely. Now I wonder whether it's just got ahead of itself. The Hang Seng has been anticipating Chinese reopening.
Greed is back. This is the Morgan Stanley Global Risk Demand Index. And we had fear in the late 2022, and we've now got greed.
Yeah.
And insiders are taking full advantage to sell, which is really quite interesting.
Yeah. Thank you to Ali Broyd for sending us this chart.
Insider selling does have some predictive capacity for the future rises, well, the future falls of the S&P 500. So, yeah, maybe it is time to put that VIX trade back on for me, Keith. And the correlation is not perfect. It is very good when insiders sell heavily. So basically, it needs to reach a certain crescendo of selling for it to be predictive.
Yes, and thank you. Yes, exactly. So there's actually very strong insider selling, and that tends to be a strong signal. And thank you to Jaw It for sending us this.
So the equity risk premium is at its lowest since the GFC. So the risk-free yield is in light blue, the earnings yield is in dark blue, and you can see those two lines have come very close to each other.
Yeah, mystifying.
Where they were in 2008. Yeah.
So, the premium you get for holding equities over bonds is tiny. We're just about to go into a recession. Seems extraordinary to me.
And if you look at the high, if you go to 2012, the premium was 7%.
Yeah.
Could have a long way to move there. Profit margin tends to correlate with sales growth, and sales growth is declining. EBIT earnings margin is declining as well. So we asked which one is correlated with which? Presumably profit margin is correlated with sales growth.
So what happens, Richard, is that during the good times, when you've got sales growth, you also add costs, you add employees, etc. But then you're slower to lose those costs, those extra employees, when sales growth disappears and declines, and therefore you get a decline in margins.
Yes. And the FANGs have broken out to the upside. They've been on this fairly steep downtrend since October 2021, 18 months or so, 16 months, and they've broken out by.
So as our technical analysis guru, Richard, what happens now? They're broken out. Does that mean it's going to go, to the moon? What happens?
They go up forever, Keith.
Right. Okay. Good. You heard it here first.
We have to change the scale on the right hand side to a logarithmic scale.
You just draw different lines now. I think is the answer.
I have no idea.
Right.
Why the efficient market hypothesis needs garbage in one chart? Yes. Stock builder bubble versus home buyer demand. I mean, build a stock bubble even versus home buyer demand. Yes, I think there are so many examples of the efficient market hypothesis being garbage, and this is a jolly good one.
Yeah, why are US home builder share prices going up? They're pretty much back to their highs. Even as home sale activity is falling. We've covered in previous weeks how some home builders are having 50% cancellation rates and house prices are falling. It's absurd. It's mad.
I think what's happening is that investors, in inverted commas, are looking through what's happening now, what's going to happen over the course of the next 6-12 months to QE. I'm not saying they're right to do it, but I think that is what is happening.
Yeah.
With all of this stuff.
Seems like a huge gamble.
Yeah.
Right. Well, anyway, we'll see. Maybe the market is efficient, Richard, and everything will turn around and their market's absolutely right and we're wrong.
Yes. It's
happened before.
Dumb money has piled back into the market. I think that's a bit unfair. I'm not that dumb. So dumb money apparently is measured by sales, by purchases of stocks at the start of the trading day. Because people who are dumb, in inverted commas, put their order in at 8 o'clock in the morning or whatever, before prices have settled down.
Interesting.
Yeah.
So anyway, whenever this dumb money spikes, that tends to be a good, market top signal, apparently. The correlation doesn't look great, actually. If you look
like something John Authors might produce.
Yeah, exactly. Precisely. If you look here when it hit its all-time high, actually, they did bloody well.
Yeah, that's right. So, yeah. They weren't that dumb, were they?
No, exactly. Okay.
Why have they done so well? It's because they're dumb. Really.
Moving swiftly on.
So Fed rate cuts are good for bonds, but equities depend on the state of the economy. Yes, I mean that is the theory, isn't it? This is 2001.
Yeah, absolutely. So you'd think everyone's talking about peak of rates, etc., being like start of the bull market, etc. You've seen just the this week the peak of the interest rate cycle being a big stimulus to the stock market. Well, yeah, but earnings matter for stocks, and we're just about to go into recession.
Yeah.
So it doesn't. In the case of 2001, the Fed cut by 475 basis points. The stock market collapsed,
and earnings misses are not being punished as much. So people are not saying that they are concerned about the financial health of the business when they report an earnings miss as much as they used to. And Goldman are reporting that companies that miss earnings have actually tend to outperform the market. That presumably is the efficient market hypothesis working, because people they downgrade them knowing that there's going to be an earnings downgrade, the price drops, and then when they announce the earnings downgrade, they know the business will do something about it, so they buy back.
All right. Okay, Richard. I'm glad you explained that.
That is the efficient market hypothesis, Keith, working. And here we have the ARC Innovation Fund, which has gone up 50% since January 1st.
It's extraordinary. Absolutely extraordinary.
Yeah, it's pretty good, actually, isn't it? But it's a long way from its highs. So you've still got plenty of time to jump in, guys.
Yeah.
This is not investment advice. This is and the comedy chart of the week is that the NASDAQ in 2022 appears to be tracing the 1972-73 Dow Jones Industrial Average performance, which suggests it's going to flatline for a few months and then it's going to drop by 30%.
Yeah, exactly. Now, you can draw any of these charts, but I think that when we get a recession, earnings fall, surely equities have to go down. Well, so far it hasn't been true, but
unless you think that there's going to be QE, Keith. I think I actually think that is that's the discriminator here.
Right.
Yes, and here we have the classic stage of the bubble, which I think is a great chart to print out and keep somewhere, have a look at every so often. Make sure you don't get caught up in it. Yeah. You don't mind being in the upside, but you don't want to get caught at the top.
Yeah. I'm waiting for despair sometime later this year so I can start buying some stocks. Okay, thank you, Richard. On to commodities and energy commodities. And it was a bad week for oil. So Brent was down 6.6%, WTI down by 6.8%. Dutch natural gas futures actually rose on the week, though they're still down decently on the year, as did UK natural gas futures. In the US, natural gas is having an absolutely appalling start to the year. It's down 45% in the first month. It was down a further 13% last week. I'll show you a chart in a second. Now, coal had a disastrous week. It was down 31%, and is now down 37% on the year. Now, in previous weeks, I had warned that coal competes with natural gas, and the coal price had held up while natural gas prices were collapsing. And that proved to be a prescient warning, because this week, coal prices caught up with natural gas prices. Uranium had a good week, up 1.9%, up 5% in the first month of this year. Some numbers specific to the oil market. US inventories rose by a further 1.6 million last week. No longer drawing down from the SPR because we don't need to. The US oil market is well supplied. US crude production was stable at its high of 12.2 million barrels a day, and the rig count continued to decline. It's now down 12 on the year. This is Brent. That brief rise is unwinding. Now, it rose on optimism over China. Reminder, though, oil and gas capex is too low just to replace the oil currently being produced. We're going to have a structurally tight market in future. And there's a big difference in BP and Exxon's forecast for future oil demand. Exxon thinks that oil demand will continue to grow over the next couple of decades and then only really start to decline towards 2050. BP, on the other hand, thinks that the energy transition is real and is forecasting quite sharp declines in oil demand over the coming decades. And that really matters for future investment. So what seems to be happening is the uncertain outlook for oil demand is disincentivizing current investment. This is the BP's forecast for energy demand. And you see they're forecasting big rises in solar, wind, energy, nuclear, and natural gas, leading to declines in oil and coal. Now, this is a very depressing chart for energy investors. This is the performance of companies listed in the UK in the oil and gas exploration and production sector. And you see they've done really badly over the last decade, despite crude actually doing okay. So oil exploration companies are currently deeply out of favor, but oil companies are currently doing very well. And Shell yesterday reported record profits, and they're kicking off a lot of cash. Now, last week, we did a section showing that the cost of hiring a floating drilling rig was rising sharply. And I commented at the time, this seemed puzzling given what we know about capex not rising. So how come drill rig rates were rising when capex wasn't increasing? Well, the answer, of course, is that there have been a fall in supply. If you look at the chart on the left, the black line is the number of floating drilling rigs in operation, and essentially they're being steadily retired, and not enough new ones are coming in to replace the retired ones. As a result, utilization rates are picking up and prices are rising. Thank you to Dr. McCullough for sending us that. So the oil market had previously been rising on expectations for Chinese oil demand to recover as lockdown ends. But you'll see here from these charts, there's a big difference between the various oil forecasting bodies and their predictions for how much oil China will use this year. OPEC are forecasting as of January 2023 that Chinese demand will rise by, about 700 million barrels a day this year. The IEA, on the other hand, are forecasting that it will rise by the best part of 1.8 million barrels, so much, much bigger, whereas the EIA are forecasting that it will actually be flat. So huge discrepancies amongst professional governmental forecasters for Chinese oil demand. And it'd be difficult to buy oil in the sure expectation that Chinese demand is coming back strongly. This chart shows Europe is still buying a lot of Russian diesel. Take a look. This is European natural gas futures, which are now back down to below their pre-invasion levels. And that's because we've had a mild winter and we have succeeded in getting alternative supplies, which means European gas storage is currently at record levels for this time of year. These are UK natural gas futures, again, fallen back a long way from their highs. US natural gas futures are falling rapidly, and this is an ugly looking chart, down 43% on the year, and the year started there, peaked close to 10, is down almost 75% since this peaks. What seems to have happened is that high gas prices last year have incentivized a lot of drilling or a lot of search for new resources, and in 1 year, you've seen a rise of 32% in US reserves for natural gas. This is the coal price, bang, catching up with the falls in natural gas. Uranium ticking up, which will please Richard. On to industrial commodities.
A bit of a correction really in aluminium and copper. They've had a good start to the year, down 2.2%, 3.3%. Cobalt, big drop on the week. I don't know why that would have happened. Iron ore, small up on the week. Lithium, still moving downwards, down 11% on the year. Neodymium up 1.6, 2.6 in the year. Nickel up a little bit, pretty much unchanged year to date. Tin has had a good year so far, but a poor week. So a bit of a correction on that big rise. Ferrovanadium up 1.9% during the week, so for its year-to-date change. And then zinc has corrected a little bit, although it had a good year. So I think the generality is that all these metals had a good start to the year, and there's been a bit of a pullback over the last week or so. There we have aluminium, cobalt, copper, chromium, iron ore, lithium, neodymium, nickel, and tin. Ferrovanadium.
Previously, we have covered a couple of vanadium companies, Ferro Alloy Resources and Bushveld Minerals. and they're both looking to mine vanadium. Now, actually, there's another source of vanadium, which is carbon black waste from oil refineries. Now, that black waste is rich in vanadium, and it's a waste product, and it actually poisons catalysts. So if you can remove the vanadium, then it would be both make the carbon black more useful, and it would provide an extra source of vanadium. And it is technically possible to do this, and there have been lots of papers on this. So the question is, going forward, we know we need a lot of vanadium for vanadium redox flow batteries. And if we can actually get the vanadium from carbon black, which is, freely available, then that would actually provide a cheap source of vanadium for VFRBs, but would then undermine the economics of mining it. So I have not been able to find any figures on if anyone's doing this and how much of they're doing it. If anyone has those figures, please get in touch. But investors in ferroalloy resources and Bushveld should be aware of this.
And there we have the graph of zinc. So most of these metals have gone up since November, and as we've discussed, really, we think in anticipation and actuality of China opening up post-COVID.
Yeah, I think some of the froth's coming out over the last couple of weeks.
I think so. So precious metals, a quiet week mostly for precious metals. Gold and silver, down 0.6, 0.7% respectively. A reasonable start to the year for gold, a quiet start for silver. And then a little bit of a moving around for platinum, rhodium, and palladium, but basically down. They're all down over the last month, probably due to a reduction in industrial demand. There we have gold, which had a good run since November, and a graph of central bank gold purchases, which were a 55-year high in 2022. So some large central bank gold transactions going through. Silver, platinum, rhodium, palladium.
Okay, thank you, Richard. On to rates. We had rate setting meetings in the US, UK, and Europe this week. So the UK raised base rates by 50 basis points to 4%, the US by 25 basis points to between 4.5 and 4.75%. Now, the next FOMC meeting is not until March. So bear in mind. Okay, so action in the rates market. 2-year yields in the UK actually fell by 25 basis points over the week, and rates towards the long end fell by much less. The 50-year fell by only a couple of basis points. In Europe, Greek 10-year yields fell by 20 basis points, Italian by 16. Reminder that the yield curve in the US is very strongly inverted. The 10-year minus 2-year is the most inverted it's ever been, and that is forecasting a recession very firmly. We have been worried about demand for treasuries and the fact that there's going to be a lot of issuance in coming years as the US runs a very big deficit. But over the course of January, all the US Treasury auctions of US government bonds were met with more bids than expected, leading to the results being below market rates. So if you bid in the auction prices were expensive because there were so many bidders. So there does not seem to be a shortage of demand for US Treasuries despite massive issuance. So this is UK 10-year, UK 30-year. Is that a downward slope to that line developing? Downwards trend? We certainly hope so. The US 10-year, which I think you could say is developing a downward trend. German 10-year, ECB remains hawkish. Italian 10-year, Greek. Richard, any change to your views?
No, I don't think I've changed my views yet. How about you?
No, same here. So skipping on, concluding comments. Well, it's been a very good week for asset markets as the peak of interest rates comes into view. And I think that is right. I think all the indications are that inflationary pressures are receding and that these high interest rates will bring inflation under control. However, equity markets have come a long way in the past 3 months. Interest rates are still rising, and we know that a US recession is a consensus view, and recession brings falling earnings. So I'm very surprised by the strength of the bounce in equities over the last 3 months, and I don't see how it can last when an imminent recession will bring a fall in earnings. Richard, what have you been up to this week?
Thank you, Keith. My relative performance for the week was down, so the all share was up a little bit, and my portfolio was down a little bit. So my relative performance has pulled back. A quiet week, no purchases, no sales, and only one chart, which is the price of gold in sterling, and it has reached a new all-time high.
Wow.
It did it on Tuesday or Wednesday.
Very good. Well, you must have a lot of gold in the portfolio, Richard.
Yeah, I've got a lot of precious metals. Yeah, definitely. But equities and yeah.
Very good.
How about you, Keith? How was your week?
My week was better. Actually, yesterday, it was really good as long bonds rose sharply, but they have retraced some of that this morning. So I was up 1.9%, which beat the all share. It's only up 1%. I'm up 4.4% year to date, way behind Richard, but actually, I'm pretty pleased with that.
Not shabby at all, Keith.
Yeah. Though behind the all share, but of course I don't hold any equities, so or very few. No buys, no sales. This is my asset allocation. I'm only about 4% equities. I've got 40% UK bonds and 10% US long bonds. So big exposure to longer dated government bonds. And this is my equity allocation, which is tiny, but my only remaining gold producer, Goldplat, their shares remain suspended as they have failed to produce their annual accounts. Keeps on being delayed twice now. The explanation coming from the company is it's not them, it's the auditors. The auditors basically they've not recovered from the pandemic. They lack personnel. Let's hope that is the explanation.
Fingers crossed.
Yeah. Okay. So this is the short-term TR24 2024 index-linked gilt. And has that stopped falling? We ask ourselves. This is US 20-year plus Treasury ETF. Had a bit of a rise. You can't say that that's a trend yet. And all the UK long-dated gilts, I think the best you can say is they've stopped falling. Now, we've seen earlier the UK Bank of England's forecast for inflation and for it to come down very sharply. If that happens, you'd expect the yields on long-dated gilts to follow inflation down. Now, one thing that I've been really surprised by over the last week is how bonds remain correlated with equities. Now, we talked last week about how I was expecting the Fed to raise rates by 50 basis points and make it clear to the market that their priority was fighting inflation. And frankly, I expected if the Fed didn't raise rates by 50 basis points, that would show that they were being weak on inflation and long bonds would suffer. Well, the Fed raised only 0.25%, and long bonds did really well, as did equities. And the fact that both equities and long bonds moved together, so they have a positive correlation, means that, to me, the market is not expecting a big recession, because if earnings remain constant, then equities have the same characteristics as a bond, and you'd expect bonds and equities to be positively correlated and to be driven by changes in interest rates. And that's what happened this week. So the market is not discounting falls in US corporate earnings in the coming recession. I think they're wrong. And I think the recession must cause a fall in earnings, and then bonds and equities will decouple. And so bonds should then do well as inflation falls and the economy goes into recession, and equities do badly. So one other thing I wanted to discuss was one of our viewers got in touch and wanted me to talk about Gulf Marine Services. We did a share talk on Gulf Marine Services last year, and reminder, it hires out drilling support vessels, but it's very highly indebted. Now, this is the share price, which has been drifting off. I sold the shares at around 7p last year, and they're down to about 4.6p now. Now, these are the latest financial forecasts. The problem for Gulf Marine Services is its debt levels. It has actually been doing well with other drill ships because of the rising utilization rates, as we covered earlier. But it's having one of its clients in Europe, an offshore wind farm, has gone bust, so it's got some bad debts. But above all, really, you're making the assumption, if you invest in Gulf Marine Services, that those drill rig rates will stay high, and that during the recession, oil prices won't collapse and take drilling rig rates lower with them. And I think that's quite a big assumption. I would prefer to wait until the recession is out of the way and we've seen a bottom in oil prices. I don't think we've seen that yet. And the trouble is, because Gulf Marine Services has got so much debt, if it misses forecasts, the share price could go a lot lower. Basically, the debt is too much to really be addressed by a rights issue. You'd have to have a debt restructuring, and the company could end up in the arms of the bank. Now, it has had very strong cash flow generation the last couple of years, and you can see it's been paying down debt. And when I think we've seen a bottom of this cycle, I'll take a proper look at it again. But for me, the cycle dominates. It's too early to take a look. Okay, and that's it. Thank you all for watching through to the end. Please, can you press like and subscribe to the channel? And in the meantime, it's goodbye from Richard Wheater.
And it's goodbye from Keith Jordan. Goodbye.
Goodbye. Actually, one other thing is that tomorrow we will be recording our key lessons from 2022. Look out for it during the week. Okay, bye.
Full disclaimer. The material and information contained in this podcast is for information and entertainment purposes only and should not be relied upon for making a business, legal or any other decision. We may own or have a financial interest in any securities mentioned. Listeners should conduct their own research or consult a professional investment advisor before making any decisions regarding topics mentioned on the show. Whilst we endeavour to ensure that the information presented on the show is correct, We make no representations or warranties of any kind, express or implied, with respect to the podcast and website or to any information, products, services or related graphics discussed or presented in the podcast or website. Any reliance you place on such material is strictly at your own risk. You are solely responsible for the investment decisions you make. We will not be responsible for any errors or omissions in the podcast or website, including in articles or postings, for hyperlinks embedded in messages, or for any results obtained from the use of such information. Nor will we be liable for any loss or damage, including consequential damages, if any, caused by a reader's reliance on any information provided by the podcast or website. Please do not listen to the podcast if you do not accept self-responsibility for your actions.